And welcome back. And in this lesson, we're going to look at how the auditor expresses their dissatisfaction with the financial information prepared by management. Now, there are two broad situations that we need to consider, which result in four different types of opinions, two for each situation. The two broad situations are, first, when we have financial statements that are not prepared in accordance with GAAP. And this can arise when there are errors that are uncorrected or disagreements in the accounting treatment of an item, or there's disclosure that is lacking. The second type of situation is when the audit has been restricted. And this may be client imposed. For example, when a client prohibits us from performing certain procedures, say confirming a receivable with a customer, or a scope limitation that can arise from circumstances beyond anyone's control. Say a client's business burns down and with it all the evidence. So with those two broad situations in mind, there are separate reporting outcomes for each of them which simply differentiate the severity of the situation. When we believe the financial statements are still fairly presented, but there was in fact a material misstatement for which we either disagree or can't gain sufficient evidence, we can issue what is called a qualified opinion. The key consideration here is that the item of contention is not so pervasive to the overall fairness of presentation. And this basically means that the item of content can be isolated to a specific area of the financial statements. And let me give you a couple of examples. So here's an example where the auditor disagrees with how the company has applied certain accounting policies. So once again, because the item is not pervasive to the overall fairness of presentation of the rest of the financial statements, then the auditor still issues an opinion only with a separate paragraph entitled Basis for Exception placed just prior to the opinion paragraph discussing the nature of the exception. Now here's an example of where we have a qualified opinion that arises from a scope limitation. So perhaps this is the first time that a client has been audited, and it would be awfully hard for the auditors to get evidence on the existence of the opening inventory. So the auditors make a reservation note about this. And once again, we add a separate paragraph prior to the opinion paragraph noting the basis for the qualified opinion. The last two opinions are fairly rare, and only because they really don't have any value. The first type of opinion we'll look at is called an adverse opinion. And this is when we as the auditors disagree with management about one or more material issues, and the impact of such issues is pervasive on the fairness of presentation in our judgment. This gives rise to the adverse opinion. Once again, we insert a paragraph prior to the opinion paragraph that discusses the basis for the adverse opinion, and then make reference to it in our opinion paragraph. And the last type of opinion we have arises when we have a pervasive scope limitation. Perhaps the client has restricted our ability to observe physical inventories and confirm receivables. And for this reason, we are unable to gather sufficient appropriate audit evidence to reach an opinion at all. And in this case, we would issue what is called a disclaimer of opinion, which basically says we can't express any opinion. So obviously that would have limited value to our users. Now what happens if the auditor issues an unqualified opinion and the financial statements are released, but later on a material error is discovered? We as the auditors need to ensure that the users who are relying upon the financial statements are informed about the misstatements. It begins with a discussion with senior management and the board of directors, and it may require us to revisit our audit work and perform additional audit work. Management will have to reissue the statements correcting the errors, or if they refuse to do so, we will have to revise our opinion accordingly. So, there you have it. Now you know how we communicate our reservations to the users of the financial statements. That's all for this lesson, so until next time, don't stop till you get to the top. When you get to the top, don't stop.